Let's go back to 1999 and visit two guys who both happen to be named Sean. Sean Fanning and Sean Parker founded Napster, an early pioneer in peer-to-peer file sharing. Specifically, the company focused on audio files, eventually creating the most sophisticated network for music sharing on the planet. Of course, this was all very illegal, and it wasn't long before record companies came knocking, suing the founders into oblivion and shuttering Napster. But the world would never be the same again. Suddenly you didn't need to buy an album or wait for a song to play on the radio. You could find it online and listen to it non-stop for an hour, or only listen to your favourite 30 seconds. Napster asked the question, what if music was truly unlimited and freely accessible? In the ashes of Napster, we find the seeds of Spotify. Thanks to the rise of streaming and 4G connectivity, the concept is all the more reasonable. Now you don't need to download the album off your older brother's shady computer. You just need to stream it. And you're not limited to one album, or even 10. There are over 1.8 million available on Spotify. All you need to do is listen to a few ads or pay a premium subscription fee. As the first mover in the music streaming space, Spotify has grown substantially over the years, amassing more than 400 million monthly active users all across the globe. This makes it the largest streaming platform in the world. Overall, its users seem pretty happy too. Spotify routinely has one of the lowest churn rates in the business, at 2%. Apple Music, in comparison, has a churn rate of over 4%. Speaking of Apple, it's worth mentioning that Spotify's success has attracted competition from the biggest names in tech. Apple, Google, and Amazon all have competing products, upon which they're not reliant for revenue. Spotify is very much the small dog in this fight, but it hopes to win thanks to its strong brand, superior personalization algorithms, and comprehensive user-generated content. That final point is very important. Algorithmically generated playlists account for 70% of listening hours, but playlists created and shared by users account for 36% of listening hours. Spotify may have successfully created a social media-like community, ensuring existing users recruit new users to the service. That being said, music is a difficult business to make money from. Spotify is very much beholden to artists and record labels, which have complete control over royalty costs. For this reason, Spotify has gone looking for new forms of listening, such as podcasts, audiobooks, live sports broadcasts, and educational content. This has seen the brand pick up some of the world's most popular podcast titles in order to make them Spotify exclusives. CEO Daniel Ek stated that the podcast segment may have a gross margin as high as 50%, a strong departure from music's 25%. It's still very early days for the business, with both risk and opportunity abundant. A long-term horizon and an appetite for volatility are a must for any potential Spotify investors. But with a visionary CEO, strong customer evangelists, and high insider ownership, there are plenty of signs that Spotify could turn into a phenomenal winner for its shareholders. Want to get more stock analysis on some of your favourite companies? Why not check out the MyWallSt app in the description below, where we have over 100 stocks that have been handpicked and analysed by our expert team. Don't forget to like, comment and subscribe if you enjoyed our content. Until next time, happy investing.